We are bouncing back. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, President Trump promises to make two key economic hires within days after painful data rocked markets on Friday. A rare setback for Warren Buffett. The billionaire's cash pile drops to just $344 billion, the first decline in 3 years. And Tesla approves a massive payout meant to keep Elon Musk's attention on the EV maker as a legal fight over his pay package drags on. Katie, what are you watching?
Well, let's get into the specifics of that pay package. Tesla approved an interim stock award worth about $30 billion for Elon Musk. The company will drop a longer-term CEO compensation package ahead of its November 6th annual meeting. But the idea that Matt mentioned, that this will keep his attention on Tesla, shares up about 2.4% pre-market.
All right, and earnings do continue. Palantir reports after the bell today. Shareholders looking for reasons to justify its $364 billion market cap, with the shares up this year more than 100%, and in the pre-market just about 2.33%. Katie?
All right, all that and more coming up. But let's go back to the big news from Friday, because now President Trump is set to make two new appointments in the coming days: a new Fed governor and a new head at the Bureau of Labor Statistics. White House economic advisor Cathy was asked if the president should fire anyone who presents numbers he disagrees with.
No, absolutely not. The president wants his own people there so that when we see the numbers, they're more transparent and more reliable. And if there are big changes and big revisions, we expect more big revisions for the jobs data in September, for example, that we want to know why. We want people to explain it to us.
Joining us with more is Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, this news, that Eric McIntyre was fired on Friday was pretty shocking. There have been significant revisions, and I believe every month this year, to the downside. Why have they been screwing it up so badly?
Well, maybe I can explain to you and Kevin Hassett at the same time. It's not screwing it up so badly, although there are questions about whether the government, not just the BLS, but the BEA and Census Bureau, can get accurate numbers, or can get the numbers as accurate as they used to be, because businesses are not responding like they used to be. We used to get 90% participation by businesses in these surveys, and now for May we had something like 42%.
Wow.
So they have to do some extrapolation. They have to use some other statistical methods to try to come up with the best numbers they can, and then they get some more numbers each month as they come in, which accounts for the revisions. Now, the biggest issue that the economy has is it's slowing down. We grew in the second half of the year of 2024 by 2.75%. In the first half of this year, the first 6 months, we grew by 1.25%. So naturally, hiring is going to slow down if the economy is slowing down. And also, you had on top of that all of the problems with trying to figure out what tariffs would be and what impact they would have on hiring, companies just sitting on their hands.
Well, the point you make about collection rates going down, really stark when you put it that way, from 90% to 42% in May. That absolutely would have an impact. There's so much more we could say and ask about this topic, but we have to talk about the fact that President Donald Trump will also have the opportunity to announce a new Fed governor in the coming days with the stepping down of Adriana Kugler.
Yes, and this is an interesting dilemma for him, because the only two seats that would come up during his term are Kugler and Powell, but Powell not until 2028. His term as chairman expires in May of next year, but he can stay on the board till 2028. So if Powell decides to stay on the board, and he has refused to say he won't, then the president only has the Kugler seat to fill to put a chairman in, unless he wants to choose someone like Chris Waller, who's already on the board. So we'll probably get a pretty good indication of who the president is going to think of as the next chair when he makes this nomination. Now, he can't do a recess appointment for the Fed, so he's going to have to nominate somebody. They're going to have to be confirmed. And given that the Senate is out now, comes back to a big budget problem that might lead to a government shutdown, your best case is they probably won't get anybody nominated and into the confirmation process until October. And if you look at the Fed calendar ahead, the only meeting after October is December 10th. And so the president wouldn't get a whole lot out of being able to appoint somebody earlier, especially since they're not likely to vote against the chair at the first meeting. They could do that, but at this point, it matters less than it might appear.
Mike McKee, thanks very much. As you were speaking, President Trump tweeting or putting out on Truth Social that he's going to pick an exceptional replacement for the BLS. He says, and I'll quote here, last week's jobs report was rigged, just like the numbers prior to the presidential election were rigged. That's why, in both cases, there was massive record-setting revisions in favor of the radical left Democrats. Those big adjustments were made to cover up and level out the fake political numbers that were concocted in order to make a great Republican success look less stellar. I will pick an exceptional replacement. Thank you for attention to this matter, MAGA.
Can I just point out that the numbers released right before the election, November 1st, and election day was November 5th, showed 12,000 jobs were created in October.
Yeah.
That was
only 12,000
not a major boost to the Democrats.
Well, something I was thinking about, we typically interview someone from the administration on the jobs report day, and I remember us asking the question to Acting Labor Secretary Julie Su many times about the revisions. So this issue, these massive deviations that we're seeing, definitely predate this specific administration starting.
Yeah, it has been an issue. It's been an ongoing issue, certainly last year as well as this year. Let's turn right now to Tesla. The stock is rising after the board approved an interim stock award worth about $30 billion for the CEO, Elon Musk. Joining us now with more is Bloomberg Tech co-host Ed Ludlow. And Ed, normally I think if a company said we're going to pay our CEO $30 billion, the stock might tank. But in this case, shareholders really want Elon Musk's attention on this company.
Yeah. And it's outlined in the letter from the board just how integral Elon Musk is, particularly to retaining talent. What they say in the letter is that, he is a magnet to attract and retain top talent, while they also acknowledge in the letter that he has attentions elsewhere with his other companies and his other interests, but that the board feel this package will keep him focused on Tesla. He has to serve the full 2 years for the full amount, 96 million shares to vest, after a full 2-year term. But what's really interesting about it is that the exercise price, $23.34. So for each share, he would pay $23.34, but the share price is above $300 now, right? $310. That's where the comp is. But we have a vote in November at the annual shareholder meeting for a much fuller, longer-term package.
All right, Bloomberg Tech's Ed Ludlow. I know you'll be all over this on Bloomberg Tech at 11 a.m. Looking forward to your reporting there. But let's zoom out to earnings season in general, because this week, 14% of the S&P 500 report earnings. Here's a look at earnings expectations. What a chart this is. It's been a very strong quarter despite tariff uncertainty, with 82% of S&P 500 companies beating estimates so far. That's the highest rate since 2021. Let's discuss with Bloomberg Markets Live reporter Michael Ball. Great to have you with us. And I know that you're taking a look specifically at the economic data, which seems a little bit out of sync with what we're seeing from corporate America.
Yeah, it's interesting. It's creating sort of a day of reckoning between the two. Last week, as Mike covered, the GDP report came in weaker. The momentum seems to be cooling. Final domestic sales, something we look that kind of excludes sort of the trade noise, was showing that after 6 quarters, almost 3% growth there, we're finally coming off this run rate. And earnings still holding in. Obviously, there's a concentration in sort of the big caps, and tech and IT, AI-related story is definitely ramping. We saw that in GDP as well. Investment outside of AI, IT, came off. But it's just kind of a conundrum that eventually it's going to have to, one side's going to have to win, and we're not sure yet.
So many CEOs are using the word fluid when talking about the tariff situation. We have a big story on the Bloomberg about how the pressure on yields is to the upside, even though right now we're down at 420 on the 10-year. You worked at the New York Fed. How do you see this data and this new policy affecting the earnings picture for stocks?
Interesting. I think stocks are being supported by earnings, as we just said. And funny enough, the data cooling is probably supporting treasuries. So you're getting the best of both worlds. And ultimately, what we need to see is when we start to get downgrades again in earnings. But it's a big economy. It's got a lot of moving parts. We had manufacturing last week and ISM kind of showing cooling. Hiring rates were starting to turn into firing talks, which was the first time we picked up on some of that. This week we get ISM services, so we'll be watching that closely. But it's a huge economy, and it just takes a while for these tariffs and all the other uncertainty to hit. And I think that's what we're really getting, the lag there.
All right, Michael Ball, great to get some insight from you. That is Michael Ball. He is one of our Markets Lives reporter. You can find him at MLIV Go on your Bloomberg terminal. Meanwhile, let's take a quick check on futures right now. Boy, we had a wipeout on Friday, but you can see a little bit of green about 20 minutes ago before the opening bell. The S&P 500 up about 0.6%, a little bit better when you take a look at big tech. That was the laggard on Friday. The Russell 2000 also punching above its weight there. Let's get specific, though. Let's talk about chicken.
Let's
Tyson.
dig into it.
Yeah.
Some of the movers here. Tyson is one that I was looking at this morning, raising its outlook as chicken sales offset losses in its beef business. And I've been paying a lot more attention to the chicken economy ever since that Odd Lots.
Beak capitalism.
That Odd Lots podcast about the chicken stock.
Yeah, interesting to see poultry outperforming cows right now. Let's also talk about Wayfair beating estimates, with analysts seeing strong upside for the e-commerce firm, up almost 13% right now.
All right, I'm going to actually interview the Wayfair
excited
CFO
for you.
on Bloomberg Business
With
Week
Carol
today
Master.
with Carol Master. I'm
What a
looking forward
dream,
to that. You saw Hims and Hers there as well. It reports after the bell. It's had a 250% surge in the past year and continues to rise. And this, I think, is for the most part down to the GLP-1s. Yeah,
there's been a lot of back and forth there. This has been a very volatile stock, so looking forward to those figures. But coming up next,
Berkshire Hathaway's profit drops as it writes down its Kraft Heinz investment, and they only have $344 billion in cash. We'll get more analysis from Cathy, Seifert, analyst at CFRA. Next, this is Bloomberg Open Interest. Warren Buffett's Berkshire Hathaway saw its operating profit dip about 4% as it took a $3.8 billion impairment on its Kraft Heinz stake. CFRA analyst Cathy Seifert says the results temper her firm's enthusiasm for the company. Cathy joins us now. She has a hold recommendation on the stock. Cathy, was this entirely unexpected here, and how serious is it?
Well, I mean, I think there were a couple of factors in these results that were less than stellar. And the Kraft Heinz impairment was not that big of a surprise. I mean, we've seen that there's been some activist action at Kraft. Berkshire's representatives resigned from the board in mid-May. So the write-down was not that much of a surprise, given that they changed the way that they're accounting for the stock. I'd also point out that they account for their Oxy investment on an equity basis and are currently carrying their Oxy position about $5 billion above market value. So, I mean, I think that's something to watch as well. I think there were a number of things in the earnings that were a little tepid, in my view.
Well, let's talk about that. I know that you have a hold rating on the shares. It seems like when you think about this weekend and what we learned there, it doesn't seem like there's a lot of pressure on you to bump up that rating.
I downgraded my recommendation late last year when top line growth was slowing. And, you know, one of the things that sort of made Berkshire stand out from a lot of its peers was their ability to generate pretty healthy organic revenue growth. Well, that seems to be coming to a halt, and operating revenues actually declined this quarter. Insurance results were very mixed. And, you know, I've also talked about how last year the insurance industry had a pretty significant tailwind. And this year, results outperformance is really going to be company by company specific. Geico's results were okay. They grew top line a little over 5%. Loss costs were contained. That's kind of similar to what we've seen from some of the other peers like Allstate and Progressive, although both Allstate and Progressive are growing their top line faster and underwriting more profitably. So there's that. Berkshire's commercial lines businesses were pretty weak. Top line deteriorated. There's some adverse claim trends. So I think the insurance results were pretty mixed. Ironically, the one bright spot was at BNSF. They got some increased operating efficiencies. Lower fuel costs certainly helped. But, BNSF is sort of in the headlines because of the notion of rail consolidation to gain increased efficiencies that they just achieved organically. So I think that's something else to watch, what happens in the rail space.
Right. Well, Cathy, given that, they had to write down that Kraft Heinz stake that they have, do you think that dampen some of the speculation around BNSF? Does the timing make sense for Berkshire here?
I mean, my sense is that, Berkshire's cash position grew to over, like $344 billion. So they're certainly sitting on a lot of cash. But I think it's also important to note that they didn't buy back any of their shares this year. And I think they're sort of standing pat. And historically, when Berkshire does acquisitions, they like to do them on their terms, not because their hand has sort of been forced because of an industry consolidation. So, I know there are a lot of rail analysts who have made the argument that, a tie-up with another railroad makes sense. What I know about Berkshire is that they historically don't like to do things, which doesn't mean that they're not going to see the writing on the wall, but it doesn't align with how they historically do deals.
Hey, what deals are there for them to do? Aside from railroads, they have $344 billion. Are they going to be able to put that to work? Do you want them to put that to work? Are there other things you'd like to see them do with that cash?
Well, I think, and this is just sort of my sense, there's a management transition going on. That's sort of the understatement. But there may be a cohort of investors once Warren Buffett is no longer sort of at the helm. My sense is that there may be pressure for Berkshire to pay a cash dividend. They're one of the largest financial firms and one of the largest companies in the S&P 500. And, relative to their cohorts, they're one of the few that don't pay a cash dividend. They also don't. They have a capital allocation plan. It's not necessarily articulated, and a lot of their peers have a better articulated share repurchase plan. As it relates to acquisitions, I understand where they're coming from. Market valuations are not cheap, and we've got an economy, and I would argue Berkshire at an inflection point, and they may be, they've warned about the impact to tariffs. My sense is they believe it's going to impact them, and I can understand that concern. So they may be waiting for equity valuations to contract a little bit.
Cathy, great to get a little time with you. Really appreciate you joining us this morning. Cathy Seifert there of CFRA talking to us about Berkshire Hathaway. Now let's get to some of the other movers on our radar this morning. And one that Katie and I both have been, astounded is too strong a word, but a little bit surprised by is the jump in Joby shares.
Yeah.
It's an air taxi, company. I've never taken a Joby.
I haven't had the pleasure, but apparently they're buying all of Blade's passenger businesses in cities around the U.S. and Europe. The CEO joins Bloomberg TV at 12 p.m., I believe, with Ed Ludlow and Caroline Hyde, which makes sense. Ed Ludlow broke the story with Sid Phillip over the weekend. I just am interested in this because Joby is the one doing the buying for a $125 million deal, but shares are actually much higher right now. So shareholders,
$125 million?
Yeah.
That's it?
That's probably
to buy Blade's business?
That probably explains some of the reaction that you're seeing in shares right now.
I would say so as well. Spotify climbing on news. It'll increase subscriptions across Europe, Asia, and the Middle East. That's a big jump for that.
Yeah.
I've never been a Spotify. I know the kids love it.
I've been paying for Spotify since college, pretty much. So you can see that reflected in shares this morning. And Boeing, more than 3,000 Boeing workers in St. Louis are on strike after rejecting the latest contract offer. Boeing shares down 1.2%. Not a huge reaction, but a little bit of a setback for Boeing.
It's a GSE.
Coming up, Morgan Stanley says to buy any stock dips. We'll ask Citi's Stuart Kaiser if he agrees. That conversation next. This is Open Interest. Morgan Stanley strategist Mike Wilson says that any stock pullback should be seen as a buying opportunity. He says that the combination of a fading inflation impulse and softness in the labor market should lead to a robust interest rate cutting cycle. Citi head of U.S. equity trading strategy, Stuart Kaiser, is at the desk. So, Stu, does that make sense to you, both the reasoning and the playbook, just buy any pullback?
I think we're probably a little more conservative than that right now. Our view has generally been rate cuts are great, but they're not enough to bail the market out if this labor market really cracks. So, our view has generally been as long as the labor market is strong, you want to be long equities unless and until that labor market starts to come under pressure. The data on Friday was, concerning enough that we'd probably be a little bit more conservative about buying dips right now than that.
You think maybe the BLS was faking it? Does it seem like it was rigged?
I would say probably it was not rigged, but all of this data is estimated based on statistics. So I guess, different people might have different views on that. But no, I don't think the data was rigged. I think, you're at a period of time when there's a lot of uncertainty for corporate America, and they're probably being a little more conservative. I think not hiring is different than firing, right? So I think what would really get the market into a troubling spot is if you saw layoffs increase in a material way.
All right, Stuart, we're going to keep you with us here because the opening bell is next, and we're looking at a pretty decent rebound, not making up everything that we lost, right,
that's
on Friday.
The thing. I mean, you can't really complain about 0.5% higher, so 0.6% higher, but we were down 2% on the S&P 500 on Friday alone, so trying to crawl out of that hole. We'll bring you through all the opening bell action up next. This is Bloomberg.
We are moments away from the start of trading to kick off this week. This is Bloomberg Open Interest. I'm Matt Miller. After a 2% drop on Friday, as Katie pointed out, we're back up, recovering 0.6% on futures here. NASDAQ getting a little bit better, up 1%, and the small caps are rising as well. You see and hear the opening bells at the New York Stock Exchange. Finance of America. The ticker is FOA, which is my fraternity at Antioch, the Fraternal Order of Antioch.
The more you know.
But they're down 80% in the last 5 years. That's not great. The chart looks really ugly. Here on the NASDAQ, Verint, which provides solutions, they're down 26% year to date. Not a great day for bell ringers,
no,
really.
No.
You're looking at Tesla stock, and it's up.
Having a slightly better day. I mean, up 1.5%. This after Tesla approved an interim stock award worth about $30 billion for CEO Elon Musk if he stays in his role for the next 2 years or so. The idea here is that this is going to keep him engaged and motivated to be working specifically on Tesla. We know that he is a CEO with divided attention given his portfolio of companies. That's worth a little bit of a pop in Tesla shares. Matt, I will point out it was up higher pre-market, so we'll see if these gains are sustainable.
What's the name of the political party that he wants to start? It's like the Freedom Party?
I think it's the America Party.
The America Party?
I don't know. You'd have to go check on X.
In any case, that could be a distraction if it happens. Palantir doesn't seem distracted. Reporting after the bell today, shareholders looking for reasons to justify the massive gains, more than 100% this year. It's got a market cap of $365 billion. All right, we're back with Citi head of U.S. equity trading strategy, Stuart Kaiser. And Stuart, we were looking at a chart that shocked me, and I think it's fair to say everybody on our team, of second quarter earnings expectations. There was a while, here it is, there was a while when we thought it wasn't going to be so great, and now we're returning more than 9%. What happened?
Large cap tech reported, I guess, is basically what happened. I mean, if you look at the path of EPS, kind of after financials reported, you had a couple percent dip in calendar quarter consensus estimates. Last week, biggest week of earnings, big cap tech reports, and those earnings numbers rebounded, as did the market. It has been the most volatile earnings season we've seen in about 15 years, though. So, under the surface, there's a lot of moving parts at the single stock level. But, by and large, I think the takeaway is going to be a lot of volatility, but, corporate America kind of delivering and at least underwriting the rally to some degree.
I think I saw a Goldman Sachs estimate this morning.
I have it right here. The Magnificent Seven apparently grew earnings by 26% year over year.
That part's not surprising to me. The surprising part is the S&P 493, the rest of the group, only up 4%.
Well, I mean, look, there's always this theme in the market. Right now, that theme is AI and large cap tech, and they're kind of pulling the weight right now. And look, that's a positive, right? Even when the 493 is under a little bit of earnings pressure, that large cap tech is strong enough to kind of right the ship. Once the economy settled down, uncertainty improves, you would expect that 493 to play some catch up. So I would look at that as a positive, i.e. the ballast that you're getting from the Mag 7 is enough to allow those other companies to kind of figure stuff out.
Well, let's meditate a little bit longer on the surprising part of that 4% for the remaining 493. Do you just trust tech here? Do you take a look at that 26% year-over-year earnings growth and say, okay, I'll just load the boat there?
And that's what I think that's what people are doing. You know, whether it's tech or tech adjacent, right? You know, you have the AI stocks, you have Mag 7, you have the power gen, which is sort of, you know, the infrastructure for that AI. All those stocks are doing very, very well. You know, the other 493, as you put it, I think under a little bit more pressure, probably from the uncertainty, you know, that's going through the system and that we saw in the economic data last week. But yeah, I think you have to, you know, cross your fingers and say, at a period of economic uncertainty, those folks are going to get us through it, and then you get the rest to play catch up. Yeah.
Let's talk more about the economic uncertainty over the economic data itself. We were having this conversation before the commercial break, and I wonder if we're entering into a period where you question the quality of the data. Does it create this new playbook where maybe you're not trading the headline number on the first Friday of every month, you're actually just trading the revisions?
Well, I mean, look, the data is the data. It's been sampled and sourced the same way, you know, for 50 plus years. I think what you're getting is because of AI and because of, you know, internet-based and alternative data, people are starting to maybe raise their expectations, you know, for the quality of the data sampling. And, you know, maybe we do need to play a little catch up in how that's done. But I don't think there's any reason, you know, to question the underlying quality of the data on Friday. The data's the data, and we just kind of accept that and move on. It's not, to me, I don't think there's been an overall decline in the quality of data. I think maybe what's happened is the standards for that data, you know, from the average consumer have probably risen a little bit.
You know, we had a great big take story on the Bloomberg yesterday about the upward pressure on yields. And yes, right now the 10-year is down at 420. But the idea is the Sell America trade, right? The baby boomers aren't saving up anymore. The Chinese aren't buying treasuries with their savings. And if you have the president starting to fire the messenger all the time and maybe even putting yes men in place, that's even more pressure on yields to rise and people to sell treasuries. What do you think about that?
I mean, look, I think what you're talking about to me is the much longer end of the curve, like 20 to 30-year bond levels. And look, there is a supply-demand issue out there to some degree. There's probably more 20 and 30-year bonds issued than the market would normally consume. And if you do get a pullback in foreign buying, that can kind of exacerbate the problem. But, you know, the 10-year yield, we would view that as just kind of the quick and dirty view on the growth outlook. 2-year point is kind of policy. That 30-year point is inflation and uncertainty. So the stuff you're getting at, if the market starts to worry about that, that's going to be the very, you know,
I'm just saying the real rate of interest is floating higher and higher, and the risk premium, if you fire the BLS head, you know, is going to rise.
Yeah, look, fair enough, but we didn't see much of a move in the long end of the curve on Friday. I think from an equity point of view, we're going to look at the bond market, and if the bond market is not getting too concerned about that long end bond yield, you know, the equity markets are going to kind of compartmentalize this, you know, into a separate category. But look, we saw this kind of late June, early July, where 30-year bond yields in the UK and Germany and Japan and the US were all kind of moving, and equities took note of that when it happened. We did not see that happen last week, and I think equities will be a little bit comforted by the fact that the bond market didn't react too strongly to that news.
And so, Stu, let's just wrap it all together. I mean, you take a look at the trajectory of the rest of the year, recognizing that we're very much in August right now. I mean, where is your highest conviction at this point?
Well, we still like being long U.S. equity risk, and we have been probably for the last 4 to 6 weeks saying stay in your larger cap, higher quality stuff, because there is a real risk from this spillover from global bond yields, and there is concern about what's going to happen to the U.S. economy. Our economists do expect a significant slowdown in the labor market and the unemployment rate to rise. So I think if you took a snapshot of the macro investment environment today, you'd say that's very positive to own equities. Inflation easing, 4.1 unemployment rate, preparing for some Fed cuts, even in that context. That's very positive. The outlook in the third and fourth quarters is we need to keep a really, really close eye on what goes on with that unemployment rate. And for that reason, we would recommend staying in higher quality stocks. And ancillary to that, I think, is the inflation print you're going to get in mid-August. Because if that inflation print is hot at a time when you just had a weak labor market report, that kind of puts pressure on the Fed from both sides of the dual mandate. So, again, there's enough uncertainty there where we want to be conservative about it, but we still want to be long U.S. equities given the backdrop.
Absolutely. Sounds like the recipe for some fireworks, at least when it comes to the economic data. Stuart Kaiser, always great to see you. Thanks for kicking the week off with us. That is Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser. Meanwhile, let's get a check on this market. You have the S&P 500 extending its rally just in the first few minutes of this Monday trading session. We're now up 0.9% on really good breath, actually. You have over 400 names in the green right now, and it's big tech that's leading. You can see up at the top, we have NVIDIA, your biggest gainer on a points basis in this market, followed by Microsoft. They're actually trading places right now. Apple, Broadcom, Meta, Tesla, the list goes on. We do have some losers, only about 80 or so. Berkshire Hathaway up at the top there in terms of losses, down about 3.3%. That is your biggest points detractor from this index. On Semiconductor reporting earnings this morning, down 7%. Not something you want to see, but still a lot of good news in this market, and you can see that on the sector level as well. It's a perfect screen behind me. 11 out of 11 in the green right now, Matt. Big tech up at the top, followed by communication services, but you can see its gains all the way down on this Monday.
What a nice way to start the week, you know, just.
It does feel good.
You know what would be better?
Tell me.
If you ran a company and the board approved a $30 billion
one of these days
payout for you as CEO. There's a catch to that, though, and we'll tell you what it is next with our own Max Chafkin. This is Bloomberg Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Kimberly-Clark is getting upgraded over at JP Morgan after its earnings beat estimates. The firm has confidence in Kimberly-Clark's volume and growth in the second half of the year. Matt, everyone needs to buy toilet paper. Next up, Coinbase is getting downgraded to a sell over at Compass Point. The firm expects a choppy third quarter because of decreasing retail interest in crypto treasury bonds. You can see shares down only about 0.5%. And finally, Spotify is getting raised over at Philips Securities. The streaming company announced it's raising subscription prices across markets outside the U.S. Not exactly great news for me, but you can see shares up 7.3% right now.
All right, so big gain there for Spotify, which Katie apparently has been paying for since college.
Like 2011.
I don't get it. But Tesla approved an interim stock award. You could afford it if you had this. Worth $30 billion for the CEO Elon Musk. And the catch is he only has to stay there for 2 years. The board says rewarding Musk is, quote, the right thing to do. Joining us with more is Max Chafkin. He's the co-host of the podcast Elon Inc., which isn't called Tesla Inc. because Elon has a hell of a lot of other stuff that takes up his attention besides the car maker, and that's what they want to change with this package.
I mean, or change, or just maybe keep the status quo, make him not start any more things. The case for this is sort of twofold. One is that Tesla shareholders did try to give him a giant pay package, which was voided by the Delaware courts. So the board is kind of saying, hey, this is a make good on that. In case the courts don't uphold this pay package, here's $30 billion. The other thing is that Elon Musk has been threatening to start a political party. And there are a lot of shareholders, now this may seem a little counterintuitive because these threats to start a political party have not been good for the stock, but a lot of shareholders feel like if only we just give him a little more money, a few more shares, maybe he'll be incentivized to not do that. And that's kind of the case here.
So I don't know if you guys know this, but I host this podcast called the Money Stuff Podcast with Matt Levine. I believe he calls it like the Elon Musk attention auction because that's really what you're doing. You're trying to pay the highest price and get Elon Musk to pay more attention to this venture. Does it help at all that it seems like XAI could become more of a part of Tesla?
I mean, the XAI thing is interesting because XAI is competitive with Tesla. So that, I think, is one of the reasons shareholders want to do this. They're worried that maybe Elon Musk will just turn around from Tesla, walk away. Now, that would be, just to be clear, that would be very bad for him from a financial perspective, because almost certainly if he did that, the price would fall, his net worth would fall, but maybe he could get excited about a different company. I think the hope here is that he keeps his attention, I guess, on the two. You know, Musk has been out there sort of threatening, and in fact using XAI as part of that threat. Like, maybe I don't want to do the great AI work that I've been planning to do at Tesla, inside of Tesla, if there's a risk that some activist investor could come along and take it over, push me out. So that's part of what's at play here. I think from a sort of normal company perspective, it's very weird to have a company that has really been underperforming, that has not been doing very well for a couple of years, turn around and write effectively a $30 trillion check to the CEO. The strike price...
$30 billion.
$30 billion, excuse me. It's probably what Elon wants. But the strike price on these shares is $23 a share or so. So we're talking, and the price today is like $308. Effectively, these are no-lose options. Like, he's going to get this money if he sticks around. There's no sort of performance bonus here or anything like that. This is just about trying to get Elon Musk get his head in the game.
Can I pivot?
Go ahead.
Because you mentioned AI, and Max wrote a story today about, I think it's fair to say, an industry that treats its customers worse than almost any other besides private prisons, right? And I'm talking about airlines, obviously. It's already the most convoluted and difficult to understand pricing structure that you can imagine. They do this purposely to hurt their consumers, right? And they're going to make it worse with AI. How's this possible?
All right, so the airlines would argue that they're not making things worse for their consumers. They're merely finding the best price, optimizing their business or what have you. But what is happening, what I wrote about today, is there's a startup out there. It's called Fetcher. They're working with Delta. That's their most prominent deal. Delta's actually been talking about this startup quite a lot over the last 6 months or so. Got my hands on a sales document that they use, and it describes kind of what they're doing. And it really gives you a vision for how buying a ticket will work. This kind of confusing feeling where you don't know whether you're getting a good deal today or tomorrow. Maybe if you wait, it'll be a better deal. Maybe if you hold off. They want to make it actually way more complicated. They want to add more fare classes, lots of shifting around. And as Delta has talked about, AI pricing, they've talked about it as this great thing because from an investor point of view, right, it makes sense. Investors love being able to raise incremental revenue, and they also love AI right now. But consumers, those are not necessarily things that they want. And you're seeing a backlash going on right now where you've had a bunch of lawmakers and so on essentially write letters complaining to Delta. Also, American Airlines saying we're never going to price with AI, or we're not going to price now. I think most people who watch the industry assume that everyone will do this because it's going to be a powerful tool essentially to raise additional revenue, see if you'll pay, hey, maybe you'll pay $20 more for that ticket, maybe $40 more. And that was actually the example that Delta gave during an investor day.
Josh Hawley, the senator, said, from Missouri, said, it's the worst thing I have heard from the already awful airline industry. And this is something I think, no matter what side of the aisle you're on, you can agree with Josh. It's just a horrible industry.
I think you're going to see a lot of stories like this because this isn't only happening in airlines. And that's one of the points one of the people I talked to for the story made. We're seeing AI and pricing in other places. Of course, you see it when you do ride hailing. And there are efforts underway. This company that is working with Delta right now and some other airlines is trying to go to other businesses. The idea is to bring this, most of us think of, oh, we're going to have super intelligence and it's going to cure cancer. Maybe, hopefully. But what it's actually going to do is just, figure out how to wring a couple of extra dollars out of consumers because it's going to be able to hopefully, from the point of view of the companies, price things more aggressively.
All right, Max. Great reporting both on Tesla and, of course, on this new AI program, which sounds like actually isn't great for consumers, maybe great for those airlines.
I'm going to tweet this story out.
Good.
You know, I'm going to use my
you
Twitter.
Don't tweet very
I'm going to use
much.
my Twitter account to share this story.
That really tells you how passionate.
It really grinds my gears.
It grinds his gears. Yeah. Bloomberg's Max Chafkin. Be sure to listen into Max's podcast, Elon Inc., wherever you get your podcasts. But coming up, Hims and Hers reports after the bell. Shares are up more than 250% over the past year alone. That conversation up next. This is Open Interest. Hims and Hers shares poised to move 16% in either direction after earnings. That is according to the options markets. Bloomberg Health reporter Madison Muller covers the company. She joins us now. So this stock is up 250% over the last year, but that comes with a whole heck of a lot of volatility. And we were talking about how this has become sort of a meme stock. I didn't realize it's become a meme stock to the extent that retail participants actually ask questions on the earnings call.
Yeah, the last couple of quarters, it's become a new tradition. Hims CEO Andrew Dudum's really leaning into the fact that they have this growing retail fan base, and he actually starts the earnings calls by taking a few questions from these retail investors and then going to more institutional Wall Street analysts. And there is a really big community. It's called Hims House, and they have a Discord channel, a Substack.
Not Hers House?
Not Hers. There needs to be a Hers House. I mean, that's
Not
the next
yet.
thing. Yeah, exactly.
Matt's going to start it.
So GLP-1s is what is great for Hims and Hers and Noom and Row.com, and you know, famously, they were $1,000 a month. Lately, I've been seeing all over socials microdosing for like just $100 a month. So massive decline. That's a 90% decline. But
not 1,400%.
But President Trump has the idea that he's going to lower drug prices to an amount that really just gets you paid. Listen to what he had to say yesterday on the tarmac.
We'll be dropping drug prices. It'll start over the next 2 to 3 months by 1,200, 1,300, and even 1,400% and 500%, but not just 50% or 25%, which normally would be a lot, because the rest of the world pays much less for the identical drug.
So essentially, he's going to make it so drug makers pay you thousands of dollars for your prescriptions.
I mean, that would be ideal. But the mechanism by which President Trump is going to do this is still sort of unclear. I mean, he's been saying for months that there's going to be tariffs on pharmaceuticals. He's been saying that he's going to lower the drug prices. And how that happens is still somewhat unclear. I mean, he's been talking about this idea of most favored nation pricing, which would essentially mean that it would align U.S. drug prices to what other countries pay. And on Friday, I think it was last week, he sent letters to 17 different drug makers, largest pharmaceutical companies in the world, essentially demanding this, but not going so far as to mandate it by any, regulatory requirements. So he said, You have to do this voluntarily. 17 letters to different drug makers and gave them 60 days to comply. So we'll sort of see what happens there. But drug makers have obviously not been fans of this, and it remains to be seen actually like how he will make this happen outside of just demanding that they voluntarily do it.
All right, yeah, you take a look at Eli Lilly shares dropping 2.6% on Thursday when those letters were sent out. Just still a lot of question marks here. That is Bloomberg's Madison Muller. Of course, we have Hims and Hers earnings after the bell today. Will certainly be interesting given the backdrop here. Let's talk about futures, though, or rather, the market's open.
Yeah,
let's talk about what the market is actually doing right now, and it's actually moving pretty meaningfully higher. Maybe not relative to what we saw on Friday, but very good breadth today on the S&P 500. 11 of 11 sectors higher right now, and it's going to be interesting to see how those bars change over the course of the week.
Yeah, absolutely.
There it is. 1% on the S&P 500.
In the next hour, we have Lori Calvasina joining us, and she says earnings are not as rosy as the market suggests. Plus, we're going to talk M&A with the master of it from Morgan Stanley. Tom Miles joins us. This is Open Interest. We are 30 minutes into this Monday morning and looking at gains of more than 1% on the S&P and the NASDAQ, which normally would be fantastic, but
normally.
Well, we're not really getting back everything that we lost.
Right, that 6,400 level, I do miss it. And of course, it's a little bit of a relief rally, as you say. Broad-based gains in the S&P 500, but the VIX still hanging out around 18.
Yeah, welcome to Open Interest. I'm Matt Miller.
And I'm Sonali Basak. We're going to bring you some breaking economic data crossing the terminal in just a minute. Let's see if it's out there. It's interesting. Yields have been staying relatively steady. You saw that massive drop-off.
Steady? Oh, you mean today?
Today,
yes,
for
okay.
now,
yeah,
just for today, just for today. You had Friday, yes, not steady at all.
Huge drop.
Massive, massive drop, and just incredible because days before that, you had yields higher, really looking at inflation worries and then those jobs numbers. We are looking also at durable goods orders falling 9.4%, a little bit more economic data. It's a little more than expected. We're going to bring in our own Bloomberg's Michael McKee for that. I know we have factory orders coming in too.
Yeah, well, the factory orders number is good news, bad news in the sense that it matches expectations, but expectations for a negative 4.8% order level, and that's down from 8.3% in the month of May. So not particularly good news for factory orders. The durable goods orders portion of it is revised down from the initial report of 9.3% negative to negative 9.4%. Capital goods orders, non-defense ex-air, the part that goes into GDP that the economists like, negative 0.8 from a negative 0.7 initially reported. So business spending was a little worse in June than initially reported, and not really a surprise given the situation that we've been in terms of a lot of companies bringing in stuff ahead of time because of the tariffs and uncertainty over the tariffs.
All right, well, we'll continue to watch for reaction to these numbers. Bloomberg's Michael McKee, our international economics and policy correspondent. On the earnings front, fluid is the new uncertainty. That word is being used to describe tariffs as they flag high levels, as CEOs flag high levels of unpredictability. RBC's head of U.S. equity strategy, Lori Calvasina, says the C-suite commentary is in line with lackluster corporate confidence, a sign for concern on Wall Street. Lori joins us now at the desk. And so we're still not sure, and that's not great news, I guess, even though earnings season seems to be pretty strong.
Yeah, look, the rate of upward revisions is running up. The bottom-up consensus has crept up a little bit, and guidance has been moving up. But the problem is everybody knew why guidance was going to go up, which was that some of the tariff rates embedded in assumptions came down. So that really explains a lot of this run-up in stock prices we had coming in. People are also talking a lot about FX, and you're not seeing really positive investor reactions to things like FX beats. I think that the problem is in the commentary. And look, I'm not bearish in here. We feel pretty neutral going into the end of the year, but things seem very messy right now after what we heard last week, especially on the state of demand looking forward.
What does it mean for any potential gray swans through the end of the year? You have a market that's assuming just a general lightening of the tariff rate from 18%, which was much higher than what people had expected, to closer to 15%, and they're okay with it. So what's going to shake the market?
Is a gray swan like a known unknown?
A gray swan isn't as severe as a black swan, but you know, a lot of the events that you've seen over the last couple of years could be considered gray swans.
I think that's a great way to put it. Look, if we look at valuation, the market cap weighted S&P 500 forward PE is a little over 25 times. That's about where it peaked out last time around. That's a bad data point. It means we're vulnerable to some of those gray swans. On the positive side, you've got AAII net bulls, which are around average. So which would tell you, people like us who are, kind of expressing some concern, that actually may buy the market a little bit of time in here. But I think no way regardless of how you sort of look at the numbers, people have been banking on 2026 being all sunshine and roses. And what I'm hearing right now is it's just going to take some time to understand not just how inflation is impacted by tariffs, but how demand is impacted by tariffs. And it looks to me like things are sort of slowly moving through the system. Does that have the potential not just to reverberate in the second half of this year, but say the first quarter of next year? I think Wall Street's going to have to wrestle with these issues. And you're having it happen at a time, the last 5 years, September and October tend to be bad for markets. So I think just the timing is not syncing up with the shift in narrative.
I saw a Bloomberg intelligence chart this morning that really blew me away. And if we can pull it up, it's earnings expectations for the second quarter. You did mention that revisions have been to the upside, but look how steep they are. I mean, This is from November. So this starts out at the Trump election and then just goes downhill until April 2nd, where it just drops off a cliff. But now it's hyperbolic.
Yeah, but so were markets, right? If you look at that move that we had off the April 8th low, this is the fastest recovery off of a growth scare that we've had outside of the COVID recession. I mean, it's really, just startling how quickly it moved up. And that's because those numbers were pretty well anticipated.
How do you guide clients to think about the Mag 7 versus everything else right now?
So, look, I'm kind of balanced on this Mag 7 versus rest of market. I would say most of my peers came into the year saying it's going to be a value year. We're going to see everything broaden out. And we said, maybe not so fast. It's been a tug of war, and we think that's going to probably continue. I have to tell you, Sonali, like going through all the earnings call transcripts the last couple weeks, the AI story sounds fine. There's nothing new, but it does not sound to me like we've had any wobbles on demand based on what the big AI companies are saying. Now, the other companies aren't talking about that as much, and I think that's actually, sort of a benefit now, because maybe that's where the kind of rollout is going to be a bit slower. There are going to be more kind of incremental bumps. So maybe it's actually good they're being a little bit quieter on that issue right now. But by comparison, the AI trade, still sounds pretty good. It is a bit overvalued and crowded, but the rest of the market doesn't look cheap either.
The rest of the market earnings growth has been, I feel, pretty disappointing. I mean, 4% for the S&P 493 compared to 26% for the Mag 7, according to Goldman Sachs. And I would have thought that the 493 could use AI to make that 4 a 5 or a 6. Like, why isn't it?
Because it's just too soon. I mean, this technology is going to take some time to really add all the efficiencies that have been promised. That doesn't mean it's not going to come at some point in time. It doesn't mean it's not going to be additive. It just means it's not going to happen right now. And you're even, starting to hear this, from some of the AI companies themselves. That buys them some time, right? They're still doing the business that's needed, and that investment is still coming through. But if you thought it was going to just help the broader economy and the broader market this year in a big pop, you're getting disappointed on that.
It's interesting. Even if you didn't have that big of a rise in the Magnificent 7 index overall, you're still having an index, according to Bloomberg's data, that trades around 35 times earnings for the Mag 7 compared to the S&P that's less than 25. What should it look like?
Well, look, and we tend to look at like a market cap weighted forward PE, and then we also look at equal weighted PEs of kind of the top 10 names versus the rest of the market. And I'll tell you, when I just do a simple equal weighted top 10 versus rest of S&P, do a relative PE, then do a relative long-term earnings growth chart, guess what? Exact same chart.
No big
just
deal.
Different numbers.
Just all that math.
Yeah,
right.
That's just what Lori does on a Sunday afternoon.
No, but
simple.
Actually kind of is, but like more at night after my kids go to bed. But the reality is they're getting different PEs because of the differential in the longer-term growth expectations. So I think when I look at that top 10 S&P PE, it's looking elevated. That's more of an absolute market problem than it is a statement about the relative valuation of top 10 versus rest of market. They're getting the multiples they deserve because of the growth trajectories.
All right.
You know I love a little math.
Always a pleasure having you on. Yeah, Sonali loves math. I just love to hear about it. Lori Calvasina there from RBC. Let's get a look at some of the single stock movers at this hour. Wayfair beat estimates, with analysts seeing strong upside for the e-commerce firm, and you can see the shares up 6 1/3%.
Okay, so we're going to explain American Eagle and Sydney Sweeney to you, I think, right? Is that what's going to happen?
I would love someone to explain it to me, because I thought the ad was like just a normal jeans ad. You have a pretty girl wearing denim
but not
for
just
a jeans
any
company.
Pretty girl. Sydney Sweeney.
Okay.
Like America's sweetheart right now. And the president also right
But why do
before
people
the show,
not like the ad?
I don't know, actually. I just saw the ad.
I don't get it either.
Why they didn't like it. But I do know that the president is defending Sydney Sweeney, I believe. A registered Republican, he says.
Yeah, because a reporter, because yesterday when President Trump got back from Bedminster and he was standing on the tarmac at Joint Air Base Andrews, someone told him, a reporter told him, that Sydney Sweeney is a registered Republican. I don't know if that's true, but he said if that's the case, then he loves the ad.
Maybe she will weigh in with her political views. Anyways, we were also watching something in M&A. This is kind of interesting. It's summertime, so people might be watching Blade, which is, of course, air company, I guess, jet company here.
Blade is a helicopter company.
Yeah, private helicopter?
No, you get on a blade like a taxi to go to the Hamptons or go to from
it's
JFK
like Uber
to Newark.
For the Hamptons, kind of. Anyways, it's being acquired, the passenger business in cities across U.S. and Europe by Joby. And the CEO joins Bloomberg later today. Joby's up, for that reason, almost 15%.
That's right. Ed Ludlow broke that story with Sid, and they have an interview with the CEO. But I think it was the price that got people excited. You don't normally see the acquirer rising, and at the open it was up 7%. Now it's up 14%. Just keeps going higher and higher because they got Blade for only $125 million.
Looks like a steal, especially both companies with brand names that have become very well known. Now, come up, we're going to talk more about M&A because it has been a hot M&A summer for bankers raking in billions of dollars worth of deals. So we're going to speak with Tom Miles. He's global co-head of M&A at Morgan Stanley. That's up next. This is Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. Tesla approved an interim stock award worth about $30 billion for the CEO Elon Musk. The massive payout is meant to keep the billionaire's attention on the automaker. The new agreement includes 96 million shares that will vest if Musk continues to serve as the CEO for another 2 years. That's essentially all he has to do is stay there. Workers at Boeing defense factories are striking for the first time in almost 30 years after union members rejected the company's modified contract offer. About 3,200 machinists walked off the job around midnight after members voted down a deal that would have raised wages by 20% and boosted retirement contributions. Kelly Ortberg said he's not really terribly worried about it. Harley-Davidson has a new top hog. The iconic motorcycle manufacturer has hired Artie Starrs, the CEO of Top Golf, to take the wheel as it grapples with tariffs and tepid consumer demand. Starrs will start his job on the 1st of October. Sonali?
Fascinating. Motorcycles and golf, my favorite things, Matt. One of those things. Anyways, time now for the Wall Street beat. Deal makers, they are raking in billions in M&A despite lingering fears about trade wars and about geopolitics. Transaction values are up almost a fifth this year at $2.2 trillion, according to data compiled by Bloomberg. The latest boost to activity comes from almost $100 billion worth of deals announced in the U.S. industrial sector alone. Joining us now at the desk, Tom Miles, global co-head of M&A at Morgan Stanley. And the industrial sector was certainly one that has been really exciting. Financials is not too far behind. Where is most of the activity going to be coming from through the course of the year?
I think those two sectors, well, thank you for having me, Sonali and Matt. I think those two sectors will continue to be drivers of the overall volume. You've got tailwinds in the financial sector, as you pointed out. Deregulation, the benefits of scale really play out in the financial sector. So they will continue to see, that sector will continue to see activity as well as industrials. And you've seen it, you've seen a lot of activity over the last several weeks as companies have finished up with plans that they've been making over the course of the last several quarters.
So what about valuations right now? Because we're not at record highs anymore, but we're pretty close to them. So how do people feel about the price they're paying for assets?
What you're seeing is the price that they're paying. They're paying good prices for good assets. And so we've seen a number of transactions at what valuations seem high today. But as you go, just like it's been over the last cycle, when the deal works out, the deal works out. So the higher valuations in the public market are certainly not scaring off buyers because most of the activity we're seeing now driven by corporates is highly strategic. So you've got synergies, you've got greater growth, all those things that get a company to do M&A are playing out. And so if you pay a price that's reflective of the market, that's what you have to pay to own the asset.
Have you seen the kind of deregulation that we were expecting, or the light touch regulation that we were expecting at the end of 24, beginning of 25?
We've only been a half a year into the new administration. So yes, you're starting to see that occur from a tailwind perspective, as I mentioned. So I think you're going to see, you've seen a few bank mergers. You've seen a number of very large transactions occur. In fact, transactions over $10 billion through July are up almost 100%. Globally, up almost 50% in the U.S. And you saw last week, you saw the Union Pacific $85 billion acquisition of Norfolk Southern. Again, in a week where we had $190 billion of transaction value. That's the largest amount of transaction value since November of 2021 in a single week. And so that activity is continuing across all sectors.
That's the deal I wanted to ask about specifically, because the idea after President Trump was elected was that we wouldn't have as stringent antitrust regulation. And this is one where you could see it as kind of monopolizing rail in the U.S. or taking a big chunk of it. Do you expect it to go through?
I know the companies expect it to go through, certainly. I think just to step back, I think from an antitrust perspective, I think what market observers would say is that there's going to be rigorous antitrust enforcement, but with the intention of having the openness to things like remedies. So that wasn't really in existence in the Biden administration. To the extent you have that type of environment, you've got companies allowed to figure out how to get a deal through and how to propose things that will make it acceptable to the antitrust enforcers. So I think you've got that type of environment and that type of backdrop for a deal like that to happen.
Speaking of antitrust, I think it was interesting. Adobe Figma was blocked, right? You had Lena Khan over the weekend and a lot of people pointing out that maybe this was great at the end of the day. The idea was to keep Figma independent, not let it be acquired by Adobe. It would have been a $20 billion price tag around that deal. Figma now, after the IPO, is almost a $50 billion company. So are there some companies here that are looking at what happens and saying, okay, let's stay independent. Let's look at an IPO. Let's forget the idea of an M&A in order to get the Figma-style treatment?
In a good, healthy market, you've got both M&A and IPO alternatives, and that's what we're starting to see. The IPO market, certainly that was a tremendous IPO, and we're going to see more of both of those types of transactions in my mind. So yes, there are some companies that are going to be better off going the IPO route, some companies that are going to choose the M&A route, and that is a healthy set of capital markets. I mean, you've got both debt and equity markets are open for business in supporting M&A, but also in supporting great companies going public.
Private equity exits have been slow and sparse. Are they going to be able to start doing more M&A so that we have less continuation funds and more money?
That question is speaking right to my favorite topic.
Yes, the monetizations of sort of long-held private equity assets remain slower than we would all like. And so you've seen an increase in continuation vehicles, minority stake sales. The good thing about it structurally is those will have to happen. And so a better IPO market, a better capital markets in general, and frankly, as interest rates tick down, all those things will help accelerate the monetizations that have to happen over the next couple of years. Will it happen in one big spike? Probably not. It'll bleed upwards, I believe, and you'll see that structural benefit to the M&A market coming as more private equity owners seek to monetize.
How much pain is there underneath the surface, though, when it comes to private equity? You hear investors talk about the types of returns they're going to get from vintages back to 2018, assets that have been held for a while. It's not looking too pretty based on what investors are saying. So are they able to sell these assets at reasonable valuations, at least at par?
It's a market, so you have some people doing better than others. What I'd say is the underlying profitability of the companies is growing over that period of time. So while the return may not look stellar, the multiple of money may get to where they're going to. And that's really the push that the private equity community is trying to solve for. And I think, we've been through this before. We had the great financial crisis. Different pockets of time have yielded different returns. And I think we're going to be in one where the facts will say that there's a pocket of lower returns, probably, they usually precede a pocket of very high returns. So it's a set of people that are looking to invest, and they continue to invest in large scale.
Could you pitch Warren Buffett a deal for his $344 billion in cash? Is there anything out there for him?
A particular criteria, but there is from an acquisition availability perspective, there are lots of great companies out there. You talked in the previous segment about the earnings volatility that's out there. That's causing a lot of volatility within individual stocks. And so I think that's another part as people who have big piles of cash that are looking to invest will see companies re-rate pretty quickly. And so you have to be on top of that. And I think from our perspective, we see M&A opportunities in every pocket of the market for people with large hoards of cash.
People seem to be dusting off their dream deals. Tom, thank you for joining us here on set. That is Morgan Stanley's Tom Miles. And we're going to have more on M&A ahead as the pressure mounts for Berkshire, speaking of Warren Buffett, to make an acquisition in the railroad space. We're going to have details later this hour. Stick with us. This is Bloomberg Open Interest. Let's go to check on the stock market right now. You have some interesting movement under the hood here. The S&P 500 still in the green, more than 1% higher. Yet you do see some interesting movement. It's big tech that is largely leading the way here. You have NVIDIA, Microsoft, Apple, Broadcom, Meta, Alphabet, Tesla, even after that Elon Musk pay number came out today, all leading on a points basis. You are looking, however, on the downside, Berkshire Hathaway, after reporting that very specific loss tied to Kraft Heinz, a $3.8 billion charge as part of its earnings. It is your biggest points decliner. Amazon is also still lower on the day. So is Eli Lilly, ExxonMobil, Boeing. Here's what the sector breakdown looks like today. Information technology leading the way, consistent with that. Tech is king. Trade here. Energy lower. Really the only major sector lower on the day. But broad-based jump higher. We're not getting back to recouping all of Friday's losses, but higher nonetheless. Now coming up, President Trump's tariff policy causing uncertainty in the recycling industry. We're going to speak to the CEO of Republic Services next.
From car makers to trash haulers, the latest batch of industrial results shows companies are feeling the pain from President Trump's tariff regime. This includes waste management company Republic Services, which lowered its annual sales guidance. The CEO, Jon Vander Ark, says tariffs have created the most challenging demand environment in a decade outside of COVID. And Jon joins us now. Really appreciate your time, and I'm looking forward to your insight on how bad this is and how it's going to turn out and how it impacts a trash hauler. I can understand a car maker, or an importer, but you are taking stuff for the most part and throwing it out, right?
That's true. Good morning. Great to be with you. Yeah, listen, the economy, I think, is a mixed picture overall. I think the consumer and small business are hanging in there pretty well. I think manufacturing and construction have been the more challenging parts in that front. And, linking back to your question, we don't create demand. We just respond to it. And so for an industrial plant or even an automaker, when their production is down, our sales are down, right? We're taking a container rather than 5 or 6 days from the factory. We're taking it 4 or 5 days. And so that's what we're seeing, which is just that shrinking of output, right, is leading to a little bit of softness in our demand. And again, our story is still a strong one. We're very resilient. We're still growing year over year. We kept our EBITDA guidance and raised our cash flow guidance. So our picture is still strong overall, but just a little bit of softness on the top line.
So construction and manufacturing, these are areas of the broader corporate world that are most tied to the real economy. Now, what anecdotally are you seeing in terms of how things have slowed down in the middle of all of the tariff anxieties?
Yeah, if you start with construction, which I think is less related to tariffs, that's really linked to the 10-year and linked to financing rates and mortgage rates. And we expected that to be relatively flat this year. And we've seen actually a little bit of further decline. So we really need the 10-year to come down. Now, the good news is there's a lot of pent-up demand for single-family, multifamily housing, commercial construction. I'm very optimistic over the next decade, but it's just going to take us a little longer to get there to capture that demand. And then on the manufacturing side, it's really uncertainty. And I think people are conflating weakness and uncertainty. I think there is substantial uncertainty with a tariff policy, and that's led to some weakness. But I think as you get stability in policy, I think you're going to see manufacturers start to reinvest. They're going to make decisions on capital investments, and that's going to be good for us on the front side of that, on the construction, and then the ongoing side of that as those plants start to produce things.
But Jon, this really drives home the point that rates are key to your business. If the 10-year floats up to 4.50 or 5% as the baby boomers stop putting their savings in there, the Chinese stop funding our growth, the risk premium rises because we're firing statisticians at the government when we don't like their message. That's going to be bad for you, too, because it's bad for mortgages. It's bad for car loans.
Yeah, I mean, less than 10% of our business is connected to construction, so it will certainly not help us on the margin. But we're very broad-based. I always say a bank is kind of the front door of the economy, and we're the back door. We serve everybody from a household to large business to everything in between. So the diversification across our 13 million customers does really help us weather certain parts of the economy that are a little bit weaker at times.
Now, you guys have been investing a lot in efficiency as well. I've seen you talk a lot about it on your conference calls as well. Where is it still expensive for you to be building these types of changes for your business, and where is it actually paying off?
Yeah, certain parts of the country obviously are very land challenged, and so where we do take things to a landfill, it's tougher to do that. So we're moving more and more waste by rail out of big population centers. So think of the Northeast. So that becomes a little bit more expensive, but we do that very efficiently over time. But I'd say broadly, we're investing. I mean, we're investing, $750 million into advanced recycling, and we're doing that really across the country and every region of the country. And we see that because there's consumer demand. And again, even though we're kind of seeing a little bit of a soft patch on the top line this year, that doesn't mean we're stopping investing because we're excited about the long term. Well, your stock has been absolutely on fire, Jon. Outperforming, almost doubling the S&P over the past 5 years. You're up almost 200%. So basically tripling, even with the recent drop that you've seen. Will that be sustainable, that kind of run rate? Well, we think again, very high floor to our business because we're not recession-proof, but recession resilient. And again, even in this current environment, we're producing great results. And then we're growing, expanding in new ways. We've moved in more industrial waste. I talked about the advanced recycling that we're doing and thinking about circularity and decarbonization as two real mega trends that we're investing in. So we think we've got more growth opportunities than ever before. So our outlook is as strong as ever.
You did talk to investors recently about the $900 million in strategic acquisitions you have spent money on, and you've said that you see the opportunity for more than $1 billion of investment in value-creating acquisitions this year alone. How much can you consolidate in the next year or so?
Yeah, the business in the recycling and waste side and the environmental solutions, the two sides of our business, it's still relatively fragmented. In recycling and waste, the top 4 players have about 50% share, so 50% is very fragmented. And then it's even less concentrated in the environmental solutions side of our business. So we've got a big pipeline on both sides. We do about 15 to 20 deals a year. Most of those are small tuck-ins, but we've got deals of every size in the pipeline, and we're going to continue to grow and expand the business. All right, Jon, great to get some insight from you. Really fascinating business, and the growth has been astounding to watch. Jon Vander Ark there, the CEO of Republic Services. Want to get a check on the markets right now. We do see a bit of a bounce in the S&P, more than 1% the gain, but we had a drop of 2% on Friday. The NASDAQ gaining more, and I think that's representative of what we've seen in this earnings season, right, with earnings for the Mag 7 companies up 26%, where earnings for the rest of the S&P, the other 493, up only 4%.
And we should say also big tech is also what's the biggest contributor behind the S&P 500 too. I think people are going to start paying a lot more attention to the big tech performance, even the top 10 in the S&P, even beyond big tech, versus everything else, to the point you're making earlier. Sluggish.
We didn't comment on the yield. I think it's pretty darn low, right at 420 right now. It's astounding considering the upward pressure on yields that Bloomberg News has been writing.
So much to talk about that, especially with uncertainty around the political economy, let's call it. But for now, let's get a look at some single stocks moving this hour. We're going to bring in Bloomberg cross-asset reporter Denitsa Seikova. We're looking at Tesla.
Yes, it's the big story of the day. Shares are up 2%. Of course, it's coming off this big stock award we've been talking about. $30 billion for Elon Musk. The massive payout is supposed to keep Musk's attention on the company. Of course, we have this 2018 legal battle over his pay package still dragging on, so obviously that's a compensation. The new agreement includes 96 million shares of the automaker, but they will vest if Musk continues to serve in the top post for now 2 years. The decision has been met with a lot of optimism. Of course, we know Tesla bull Dan Ives. He said removes an overhang on the stock and likely ensure Musk remains CEO for several years. There has been a lot of turmoil for that stock. It's been lagging behind the Magnificent Seven, but we've seen some momentum, especially after the rollout of the long-promised driverless taxi. That said, the stock is still down more than 20% year to date, and we're a long way from seeing a big return. Looking at Spotify, the opposite story. Company is up 50% year to date and is rallying even more today after it announced price hikes. We're talking about South Africa, Middle East, Africa, Europe, Latin America, pretty much all regions apart from the US. Shares are up 6%. Spotify has been under pressure from investors and record labels that they can actually rise prices. And what we've seen there is it's one of the brands where consumers are least likely to cancel. The price hikes follows a disappointing earnings release last week. The company report it has slunk to a loss due to higher than expected expenses related to employee compensation, but we're seeing a return here. Another company that's seeing a great day is Tyson Foods. It's all about chicken. Their forecast is strong as chicken demand helps it withstand losses of its beef business. Shares are up about 4%. We've seen severe shortages of cattle, sending prices for beef through the roof. And at the same time, they've seen to cushion that due to the impact of stronger demand for chicken. Obviously, that's a little bit cheaper alternative, and consumers have been drawn to that. Company chicken unit posted the highest adjusted operating profit since 2016, exceeding all estimates. Small loss on beef, we're talking about 151 billion, but the company is down 5% year to date. Much needed relief today. Back to you, Matt.
All right. Thanks very much for that. Denitsa Tsakova, a cross-asset reporter for us here at Bloomberg, looking at some individual stock movers. I also want to point out Figma declining today after the massive gain we saw in its first day of trading last week, and then a follow-on rise for a while on Friday, but now losing a fifth of its value still doesn't hurt from a $33 IPO price.
It traded as high as $142.92 on Friday. It's still almost triple its IPO price of $33 a share. So still flying quite high, still more than a $45 billion company, but certainly a lot of that reality coming back to life in the stock. A lot of retail investors were very interested in it as well. We'll see where it goes.
They did the IPO and raised $1.2 billion and then subsequently quadrupled. I feel like they could have raised more like $4 billion.
I feel like you feel very wronged by the IPO market this year between Figma.
Well, anytime there's a pop like that on one day, I'm not sure if anyone was
the bankers do their jobs.
Yeah.
You know, there was this big saying, and a lot of people are keeping an eye on how this goes, whether there'll be fewer and fewer banks working on IPOs in the future, and price discovery will be found in a more transparent way through some of the market maker lawyers. We'll see. But, for now, no one's complaining. People have made money. And coming up next, we're going to switch gears. We're going to talk about that political economy that we were talking about here. President Trump is promising to make 2 key economic hires within days.
And slash drug prices by 1,500%.
But I think we're going to have to talk about the most, not the new hires, but why people were let go and the impact that's going to have on how people read economic data. We're going to head to Washington next for the latest. This is Bloomberg Open Interest.
The bottom line is that there were people involved in creating these numbers. And what we need is a fresh set of eyes over at the BLS. And there are great career staffers. One of the top BLS staffers is actually working in the White House to help us understand the jobs numbers. When I saw the jobs revisions, I literally called up that person and said, I think there's a typo. Because I've been following these numbers all the way back when I worked with Alan Greenspan for something like 40 years, and I've never seen revisions like that.
That was White House economic advisor Kevin Hassett speaking yesterday. Trump is set to name a new head of the Bureau of Labor Statistics and a new Fed governor in the coming days. We're going to head to Washington to get a read on those changes. Joined now by Balance of Power co-host Kayleigh Lines. Let's start with the Fed for a moment here, because I recall a conversation that we had just a couple months ago with Treasury Secretary Scott Bessent. And at that time, he said that, you don't need to wait until next year, really, in order to, or later into next year, to be able to appoint somebody to a post that would eventually take on the chair role at the Federal Reserve. He was referencing Adriana Kugler's spot here, who now we know is stepping down. So the person that is chosen, how much pressure is there on that person, given that that could be the next Fed chair?
Well, that's the exact signal we're looking for, Sonali. When we had that conversation at Bloomberg with the Treasury Secretary Scott Bessent, that was under the expectation that Kugler was going to be out after the end of her term, which was scheduled to be January of next year. She, of course, is taking an earlier departure than that at the end of this week. So this is an even earlier than expected opportunity for the president to install someone who is more in line with his view of monetary policy, which is, of course, a bias toward lower interest rates. And who that person actually is selected to be, which we expect to learn in the coming days, could be very telling as to who the president is thinking ultimately will be the one to succeed Jerome Powell as the chair of the Federal Reserve. Some of the names we are watching include the aforementioned Scott Bessent himself, as well as the NEC director, who we just heard from, Kevin Hassett, whose name has been floated for the next possible chair, as well as the former Fed governor, Kevin Warsh. If any of those are selected, it could be seen as them essentially securing a spot on the Fed board as a governor before ascending to the role of chair. That's not to say that the list necessarily ends there, but we know President Trump has signaled that there's just a few names that he has in mind for this position. All of that said, I would note that we spoke with a member of the Senate Banking Committee, Mark Warner, on Friday after the news broke of Kugler's resignation, and he suggested to us that we should not assume that it's just going to be a rubber stamp confirmation process for whoever the president wants to be the next Fed governor. As there are even Republican senators who have grave concerns around Fed independence and would like to protect that. So he was signaling that it might not necessarily be the easiest path forward for confirmation, which will be necessary for whoever takes this role.
Hey, Kayleigh, I want to ask about, I'm going to throw you a curveball here and ask about drug pricing, because I was listening to the president yesterday on the tarmac after coming back from Bedminster, and he made this interesting point on pharmaceuticals.
We'll be dropping drug prices. It'll start over the next 2 to 3 months by 1,200, 1,300, and even 1,400% and 500%, but not just 50% or 25%, which normally would be a lot, because the rest of the world pays much less for the identical drug.
So it's mathematically impossible to cut the price more than 100% unless the drug makers are paying the consumers. I feel like I've heard him make this point before. Does he often say that he's going to cut prices 1,500%?
Well, he often speaks in kind of these larger numbers, Matt, that don't necessarily make sense mathematically in reality or ultimately come to fruition. What we do know, though, is President Trump has actually been incredibly consistent about his desire to see drug prices lowered. We saw that with an executive order on the most favored nation policy earlier this year, back in May, followed up by the 17 letters he sent to the CEOs of 17 different pharmaceutical companies last week, essentially outlining different steps he would like to see them take in the next 60 days, including lowering prices. Some of those letters, of course, were personalized, where he crossed out the formal name, writing things like Len, for example, or using the more familiar names with those CEOs that he is more familiar with and has a relationship with. But he does want, indeed, to see these drug prices lowered, and he made that very clear through those letters that were publicized last week. We also know, of course, that when it comes to pharmaceutical costs in general, this is something that is under investigation actively through a Section 232 investigation, as the president and the others in his administration are looking at implementing tariffs on pharmaceuticals coming in from other countries, as he wants more of this industry onshored in the U.S. as well. We could see the outcome of that Section 232 investigation in the coming weeks. The president, of course, has suggested that this could be a longer time horizon on the actual implementation of these tariffs, that actually they could start lower and ultimately get higher over the course of 12 to 18 months to allow for some time for those supply chains to come onshore. But through that effort and through, of course, his direct outreach to the pharmaceutical companies themselves, you can see that this is actually something that he really would like to achieve, knowing healthcare costs are a very visible cost for the American people who, by and large, according to polling, are not incredibly satisfied with his economic policy and his ability to address overall costs so far in the second term.
Kayleigh, we thank you so much. Catch Kayleigh Lines today on Balance of Power at 1 p.m. Eastern, then again at 5 p.m. And coming up, we've been talking about it all morning, a bruising quarter for Berkshire as it takes a nearly $4 billion write-down on its Kraft Heinz stake. We're going to parse through the details next and talk about what it means for future M&A. This is Bloomberg Open Interest.
Warren Buffett's Berkshire Hathaway saw operating profit dip 4% as it took a $3.8 billion impairment on its Kraft Heinz stake. Here with more analysis on the second quarter report is Matthew Palazzola, senior insurance analyst at Bloomberg Intelligence. Matt, great to have you on the program. I saw the headline, $3.8 billion, and I thought, they have $340 billion in cash. It's not that big of a deal.
No, Matt, you're 100% right. Clearly, this investment not going well and the way Buffett had hoped, but that write-down is 0.6% of their shareholders' equity. So Berkshire's not in trouble due to this announcement.
So since the investment, though, we should note that the stock of the company, not Berkshire, Kraft Heinz, has dropped by 62% since this deal happened. This happened with so much fanfare, Matt. This was a big bet that Buffett was making to help the merger go through. But the failure, frankly, of this deal for him, what does it say about his future M&A aspirations? This used to be somebody who was a giant in the room when it came to M&A, not so much lately.
Yeah, I mean, so we know he is stepping down as CEO at the end of the year. He may be looking for something in between now and then. M&A has been pretty minimal since they bought Allegheny a couple of years ago.
But can Berkshire be a significant acquirer without Buffett at the helm?
I think they can. I mean, $344 billion is a lot of capital to acquire things. I think Greg Abel is, and he hasn't been as public as Buffett, obviously, but I think he is a good deal maker, and I do think there's deals to be had.
Well, we just talked to Tom Miles, who runs M&A at Morgan Stanley, and he said they could think of a number of acquisitions for Berkshire Hathaway.
But if it ends in a $3.8 billion write-down, then is our investors going to reward
the deal?
Of course.
If it's as bad as that one that they did, it wouldn't be great. But they've done good acquisitions as well.
They've done many good ones. Could I just add, though, they hold Kraft Heinz investment on the equity method, right? So they have been holding it for more than the stock has been worth for a while now. So just because of the accounting rules, they were going to have to write it down if the stock didn't move. So I don't think this is like a vote of no confidence or things like that in the stock.
All right, Matt, thanks so much for joining us. Matthew Palazzola there. He runs our insurance coverage at BI. We're getting some headlines across from President Trump saying he's going to be substantially raising the tariff paid by India, this in a Truth Social post.
Yeah, he says that they're not only buying massive amounts of Russian oil, they are then, for much of the oil purchased, selling it on the open market for big profits. That's according to what Trump is saying about India on Truth Social. They talk about the war in Ukraine and India's concern about it. Listen, after the actions taken on Switzerland, certainly the market is paying attention to one of the most important trading partners. You also think about how Apple has been looking to manufacture more in India. This is an important, strategically important country.
But I think it's interesting. This has been happening for years under the Biden administration as well, and no one's really done anything about the fact that India buys the Russian oil that's sanctioned and then sells it on to the rest of the world. Coming up tomorrow, investor Nancy Tangler joins us, as well as Cameron Dawson of New Edge Wealth.